Ladies and gentlemen, now it's the time, and I'm very proud that I have the honor to present of one of the greatest traders veterans we ever had in Chicago, and he's waiting for me now. And yeah, it's one of these moments um, in a webinar at WH Self Invest together with the CME group, and I'm very proud that I could introduce Dan Gramza from Chicago. Hi, Dan.
Hi, it's great to be with you, Stefan. Thank you so much for such a kind introduction. Now I really have a lot of pressure.
Oh, no, no, no. Don't worry. So we have exercised it, so we will do it very smooth.
Okay, that
Okay.
sounds great.
So at first I will give you the screen. Ah, there you are. Oh, you did
Okay.
great. Oh, very good. Very good.
Thank you.
So at first I will give you the screen.
All right. And let's see here. Let me grab my stop sharing. And if where is I'm looking for my share the screen. Oh, I'm already sharing. I should show my screen. Okay, now I got it. I see what you did. That was
Ah,
very
there,
clever.
we have it.
Oh,
There it is. Yeah.
that was very good. Uh, so right now you should see some charts.
Yes, I see your charts. I see your lines, your special lines, and I'm pretty keen to see what you are doing with this.
Okay. Well, here we have some stock indices. I should tell you that these are the markets we're going to come back and take a look at. But
Okay.
before we do that, there's some ideas that I'd like to share that I find helpful and I hope others do as well. So let's put that aside here for a minute. And I have a PowerPoint presentation, which is what you should see now, correct?
Yes, yes, I
Okay,
see.
great.
Very good.
Okay. Well, what we're going to be talking about is this essential drivers of intermarket trading relationships. And what does that mean? It means that when capital moves from one market to another, for example, when we look back at the charts that we just saw, when the stock market's going down, that means people are selling, they're taking money out. Where does that money go? And are there relationships that you and I could look at intermarket between these different markets to give us some clues? I think there is, and that's what we're going to be looking at today. But let's take, to give you a little bit about my background. First, I also want to tell you that none of the organizations we're working with today, the CME Group or WH Self Invest, they're not endorsing anything I'm going to share with you. These are ideas that I hope you find helpful. And my background comes from the trading floors in Chicago. So it's how I approach the markets, and it's also how I define certain things. And we're going to look at some price action a little bit later on. There's two, when we think about markets, there's, as many of you know, there are two major categories: fundamental concepts and price action. You and I are going to look at both today. And so I'd like to start with price action. And what we're looking at here are price action. I mean fundamentals. So we're going to look at price action later on. And what these categories are what I used. Um, it's how I define or put into a category different fundamentals that come out. And these are not standard definitions. These are just Dan things. So we have known fundamentals. Price reacts to a regularly issued fundamental report. So first Friday of the month, we have in the United States unemployment numbers. We have specific fundamental reports that come out on a regular basis. Then we also have what I call anticipatory fundamentals. In other words, prices react to a possible future event that hasn't occurred yet. A quick example would be In the United States, I live near Chicago. And so in July, if we're going to talk about soybeans for a minute, in July, let's say the Weather Bureau comes out and says, we're going to have drought conditions through August. What that would mean is typically you would look at soybeans and soybean prices would go up because the first 2 weeks of August for soybeans is critical for moisture. And if we don't have enough moisture, it's going to have an impact on our crop. So the market now moves up. Soybean prices move up on the announcement of a drought. Now, is that a problem? Why is it moving higher? Because it's anticipating the possibility of not having rain the first 2 weeks in August, and we have failure of our crop. But it hasn't happened yet. Now, that becomes important for me if I think about that, because if I have bought soybeans and the market's moving higher, I want a relatively tight stop. Because what we both know is if in August we start getting rain, well, this anticipatory fundamental is not happening. We are getting moisture. So soybean prices would now come down, and they probably would come down dramatically. So I want a relatively tight stop. We also have shock fundamentals, things where nobody saw this happening. A terrorist attack, for example, would be a shock fundamental. The thing about shock fundamentals is they rarely cause a long-term trend change. Do they cause volatility? Absolutely. But is it typically a dramatic long-term trend change? Actually, it's not, if you go back and look at those events. We also have euphoric fundamentals. And you and I had an example of that this week, where the price reacts to a news or event when it's announced is unknown. In other words, we know there's going to be some vaccine, some company in the world. There's over 130 companies, that are working on a vaccine. So do you and I expect a vaccine to be created? Yes. Monday, we get an announcement that there's a possibility or we're getting positive results for this test on a vaccine. And we saw, and I'll show you how the market reacted to that. But typically, euphoric fundamentals also do not cause a long-term trend change. And you and I can look at an example of that in just a bit. Reality fundamentals. These are when the price reacts to the reality of not enough. There are supply shortages, there is high demand conditions, and we don't have enough. That kind of trend, if I'm in that trend, I want to have a very loose stop because we're going to have volatility as that market moves along, but I want to give it room. So in anticipatory fundamentals, I want a tight stop to my trend. In reality fundamentals, I want to give it room. I want to let it move. So those are just some ideas that I think about when it comes to looking at these relationships. And so when you hear a news story and it says the market was down today because of a concern about so and so, so and so, that is not a long-term trend change. Is it volatile? Yes. In my opinion, it's not a long-term trend change, because it's the market reacting to a concern. Concerns do not create long-term price changes. So when you read a news story, think about some of those characteristics. What is it telling you and me? Is this an opinion? Is this a concern? Is this an outlook? Or is this reality? I think it has a big impact on how you and I might manage our positions. So let's look at some of the drivers of these intermarket relationships that we're talking about. Economic drivers. I mentioned the fundamental reports that we're both aware of. Where is the economy? What's happening with the economy? In fact, interest rates are a critical part of this. The Federal Reserve policy, and for me, the US Federal Reserve policy is probably the most powerful economic group in the world. They have a tremendous amount of power when it comes to the US market. So when you think about what drives the US market, it's really the Federal Reserve. Their policies have a tremendous impact on our economy. The president will get blamed or get praised if the economy does well and gets blamed if it doesn't. But the president doesn't have the direct impact on our economy like we do with the Federal Reserve. The Federal Reserve determines how much money is available. How much money there's only so much US dollars available in the United States and also in other countries. There's only so much, and they can have an impact on what's available. The president has an impact on what we spend. The president has the fiscal policies, between them and Congress and our legislature, they can decide how we're going to spend the money. The president can also create belief. They can create enthusiasm. They can get people thinking this is good, that the market will be moving and that the economy is positive. So they can have an impact in that way, the psychological impact. But the Federal Reserve, very powerful. Forex, currencies are also has a deep power within markets. Forex is interesting. If you look at that, what does a currency mean? It's a measure of the economy of a country. Do people want to invest in that country, which puts demand on that currency? Are people pulling away from that country because of uncertainty in that country? For example, let's talk about 9/11. When we had that, what happened? What you typically expect when you see a terrorist attack is the currency of that country goes down because people are selling that currency. They back away. Their stock market goes down because there's uncertainty. We're not sure what's happening. So the Forex market is a very interesting barometer for other markets. Crude oil also is one. Crude oil has an impact for all of us when we go to buy gasoline or petrol for our car. If gasoline prices are going up, I have to spend more money to fill up my tank. And that means I have less money to spend on other things. And that is a big deal. In the United States, 70% of our GDP is based on consumer spending. So if you put more money in people's pockets, they spend more, that's positive for our economy. Take money out of their pocket, or in this case, spend more on energy, you're going to get less spending in other areas. The other thing with crude oil is it's a delicate balance. If crude oil prices get really cheap, what did you and I hear? Oh, the profitability of oil companies are going to go down. It's a bad situation in that regard for those companies. Possibly so. But remember, these exploratory companies are highly diversified. On the other side, when crude oil prices go up, what do you and I hear? We hear, oh my gosh, it's so expensive, that we see companies, now their profitability is impacted because they're spending more and more on energy. So it gives them less money to spend on other things. So crude oil prices is a very delicate balance, and I can't wait until you and I look at crude oil in just a bit. Precious metals. As you can see here, I call it an excuse market. And the reason is if supply and demand does not really come into play when you look at gold or silver. It's a market that moves on belief. It's a market that moves on perception. And it's a market that moves on the idea of what is value. So it's a very unique marketplace. Typically, we expect precious metals to move up, gold and silver to move up in times of uncertainty or a very weak US dollar, high inflation. Those are all tools or fundamentals that can stimulate precious metals. And it says something about the long-term attitude that people have. The idea being that precious metals will hold value. If the sky falls and the world falls apart, gold will have some value. You know, if you look at central banks, emerging countries, they are holding on to tremendous amounts of gold. They're increasing their supply. In fact, I remember a number of years ago being in Frankfurt and visiting, not for work, but visiting with a friend of mine at the Bundesbank. And we had lunch, him and another economist. And I asked him, I said, how much gold does the central bank need to hold? You know, it's not used to back any currency. The last currency that was backed by gold was the Swissy, and that stops in 1999. So we don't have any currency backed by gold. So why does the central bank need gold? And it goes back to perception. How much is enough? Who knows? Well, supply and demand for any good that has that type of parameter, commodities we see, that is an important parameter. And also perceptions of the reality of supply disruptions. If people believe something's going to happen, that also creates something. And it makes me think of it. Oh, actually, this is a long time ago too. Now I think about it. But uh, I had a course with some crude oil companies here in Chicago. They are from different parts of the country, but I mean, the course was held here. And I was trading my account while we were doing the class. And overnight, we had a North Sea oil platform blow up. Now, crude oil, what did it do the next day? It opens up stronger, the market's moving up. And these oil companies were saying to me, you know, Dan, that oil platform is not a big deal. It's not going to change supply at all. And so what happened? The market opened up strong, but as it absorbed that information, it went lower and lower and lower, and it went below the previous day's range. But it was the perception of what would happen. And that's why it's important for you and I when we look at these relationships. Is it the perception of something happening, or is it really supply and demand? We can also look at terrorism. That's not tourism, terrorism. That also becomes an important parameter, or war. We know it's disruptive. It creates potential supply and demand situations. It also creates perceptions of uncertainty because we don't know what the outcome is going to be. Geopolitical factors. What we all know is we are all connected economically. I wake up in the morning looking at what happens in Europe. It's important to me to see what's going on there. It's if I look at what's happening, for example, now we have some dynamics that are happening with different countries. Does that have an impact? How is the market absorbing that information? That's what we want to be aware of. Government regulations, the stroke of a pen can have a tremendous impact. You know, we would see this, for example, when President Trump would sign one of his executive orders or a bill that was passed. That signature can have a tremendous impact on an industry, on a market. So it's something we want to be sensitive to. And the perceptions and reality of domestic and international economies. What is going on there? And we are all connected, as we know. Weather and storms can have a tremendous impact. You know, when we have, for example, storms in the United States, we have a lot of storms that will, hurricanes that will come up to the Gulf of Mexico. Well, that's an important area for us when it comes to crude oil. 80% of our refining capacity occurs in Texas and Louisiana. And we have a lot of offshore platforms that are hundreds and hundreds of wells in the Gulf of Mexico. So storms coming in that area, they have to shut those down, and you can't turn them on like a light bulb. It takes a while to get them back up and functioning. Also, you know, it's important to look at global demand from emerging nations. One of the things that I look at, and this is just a Dan thing, is I look at this. What what is happening with the consumption of protein? When I look at an emerging nation, well, let's look at China for a minute here. China, their consumption of chicken's up 500% over the last 10 years. They're the world's largest consumer and producer now of hogs, of pigs. What happens when you and I get more money, or anyone gets more money, disposable income? They may change their eating habits. So what I look at when I look at the economy of a country, I want to get a feel for what is their consumption of protein. Now, if China is consuming a lot more protein from animals, therefore they have to feed those animals. And can China grow enough of the crop to feed those animals? Now, typically for those animals, they'll come to United States, Brazil, and Argentina for corn and soybeans. So that global demand does shift. And that's something you and I would want to be aware of. Now, there's a few other things that I just want to tell you because I'm so doggone excited about it. And that is these micro index futures. If you haven't seen these yet, this is something that the CME created last May, I think it was. The success of these products have been tremendous. And if you're not familiar with them, I'd like to tell you just a little bit about them. The features are they're 1/10 the size of an E-mini futures contract. They reduce the amount of money you need to take a long or short position in the market. They also reduce the dollar exposure of a price change. And we'll take a look at that. And so they also create an environment. And I think this is the important part for you and I. What do they do? Well, they increase a trader's comfort and confidence in taking a futures position. They increase the trading strategy versatility. Now, I'm not looking at the dollar amount. We're looking at the strategy itself. We'll talk more about that. It can provide portfolio diversification. So if you're interested in trading something in the United States, these micro futures may be the ticket. Now, let's say that you and I want to invest. I thought we'd just go through quickly an example of $17,500 in the S&P 500 in the United States. And let's assume that the index level is trading at 3,500. Now, what I'm going to tell you only applies to stock index futures, because that number is not dollars and cents. When you look at the futures market for a stock index, that represents the level of the index, not dollars and cents. So to convert that number to dollars and cents, they will give you a thing called the multiplier. And for the micro, it's $5. So the dollar value of one micro futures contract, here's how you calculate it. You take the 3,500 times the 5, and that gives you 17,500. That's where I got the number. So let's take a closer look now. The similarities and differences between the ETF and the futures. The current level of the ETF, now that's in dollars and cents because it's a share price. That's $350. The micro futures is 3,500. Let's calculate how many shares we need to buy to equal 17,500. So we divide that number by 350. We need 50 shares or one futures contract. Here's what I want you to keep in mind. At this moment, you and I have equal exposure. If I bought 50 shares of the ETF or I bought one micro contract, my exposure is 17,500. They're equal. They're on the same index, so they move together. There are some differences though. We'll look at that in just a minute. Minimum tick size, it's the minimum amount the stock can move up and down. That's 1 cent. In the futures, it's a quarter of a point, 0.25. So the tick value of 50 shares times 1 cent is 50 cents. So every time the ETF moves up or down, the minimum amount I would make or lose 50 cents. Over in the micro futures, it's $1.25. So the minimum you would make or lose per tick, per 0.25 movement, is $1.25. Let's talk about cost. The margin for the ETF, if I bought margin, excuse me, on a US stock, bought it on margin, it means I put up half the money and my broker puts up the other half. So I'm taking a loan on the other half of the money. But it's a way for me to use less than 17,500 to buy those stocks, those 50 shares. And now, in futures, margin has nothing to do with the loan. The margin is the amount of money that will be allocated to every futures contract you hold, whether you buy or sell. Now, in the micro, it's $1,320. So that means if I bought the E-mini micro when it's trading at 3,500, I would have $17,500 exposure to the market. To get that, $1,320 in my account would be allocated to that position. I can't use that money until I close a position. Then that money goes back into my account. Also, that number can change. Doesn't change very often. But if the S&P becomes wildly volatile, that number could increase. If it calms down, becomes less volatile, that number could decrease. The Chicago Mercantile, the CME group, the board of directors decides if they're going to change that. But you should be aware of that. But what does this show us? It shows us an example of leverage. So that's what I meant when I said it takes less capital for you to gain that exposure in the US market. Also, if I'm taking a loan in the ETF, I have interest to pay on that loan. There's no loan involved with futures. If I'm short, I have a short fee. Micro futures, I can buy or sell, it doesn't matter. Fund expense, you have that with an ETF, it is a fund. You don't have that with futures. Also, let's go on. Structural differences. ETF, you have day trading restrictions. You don't have that with futures. You can buy or sell it as many times as you want. Inventory required for a short position, yes. For ETF, no for futures. Tracking error, and that's a difference between the ETF and the underlying index. Sometimes there's an issue with that. You don't have that with futures. 24 hours, no for the ETF, yes for the futures. That is a big deal. I get to go to bed at night seeing what Asia's doing. I get to wake up to see, again, what you're bringing to me. You get to see what happened in the United States. You get to see what happened with Asia. What is Asia bringing to you? Is it stronger? Is it weaker? It can provide us with tremendous insight. Well, there's a couple other things I just want to mention, then we're going to get to the markets. And that is a micro index futures, I believe, allows us to focus on the strategy, not the money. So let's say that you and I look at a technique on the S&P 500. Let's say it's the mini S&P 500. And the risk that we have to take is 30 E-mini points. Now, so I have the E-mini and I have the micro. That risk in terms of dollars and cents would be 30 times 50 or $1,500. Now, imagine the trader who says, oh, 1,500, my strategy requires me to use 1,500. I'm not comfortable risking 1,500. Well, at that point, as you and I know, that trader should not do the trade. If they're not comfortable, it shouldn't be done. But imagine the trader that says this, well, I don't want to risk 1,500, but I could risk 800. I'm more comfortable with 800 of risk. Well, what do you and I know about this? That person is not following their strategy. The strategy said 1,500. They're going to use 800. So what happens? They get stopped out and then the market goes in their direction. And they're probably going to say, oh, these stops, they just don't work. Well, the person's not following their strategy. It's where they put their stop, not that they don't work. So they were focusing on the money, not the strategy. That same trade in the micro, that risk would be $150. So if that trader was comfortable at 800, imagine how they feel about 150. What are they going to focus on? Not the money, because that's maybe not the issue for them now. They're going to focus on what does their strategy require. Is that powerful or what? It's powerful because what am I going to do then if I'm that trader? I'm going to start following my strategy. My profitability actually may increase, and my confidence increases, and my comfort increases. And now that I see that my strategy is working, well, maybe I do start trading the E-mini S&P 500. Maybe I do trade other markets. It allows me to make it work. So that's why I think the micro becomes so powerful. There's a few indices, all the major indices, they have the micro contracts on it. And also, not only in the indices, you got to check this out. They also have it in microcurrencies. 6 major pairs are also microcurrencies, and they have it in metals. You can trade micro gold if you wanted to. So if you've never traded futures before, maybe these micro contracts may be a place to begin. Also, if you're trading right now and you want to work on a strategy, you want to put it out there real time, the micro contracts may be a tool that you can use to help you do that. Now, let's take a look at options. I just want to tell you this is something else that was just recently released. You ought to know about this one. Smaller sizes, again, flexibility to fine tune your exposure, limited downside risk that we have with options. Smaller notional value, again, requires less margin and premium to trade, greater control over your risk reward ratio of your investment. They're 1/10 of the size of the E-mini options contract. So, and the multiplier for the S&P 5 and for the NASDAQ multipliers too. Right now on the micro options, we have it on the S&P and on the NASDAQ, not the other indices at this point. It derives the value from micro futures. The expiration delivers micro futures. And when it comes to expiration, they're quarterly expirations, monthly expirations, Friday expirations for weekly options. So now you have a lot of choices. Depending on your strategy, depending on your risk, depending on your opinion of what you think is going to be happening, now you have a way to express it in different time frames. So a few things to keep in mind: less cash to enter, smaller tick size, allows you to focus on the risk of the trade, not the money. No day trading restrictions, no inventory requirement for a short position, no tracking error, virtually 24 hours of trading, a fair and level field for all participants. Here's the deal. The CME Group is the largest futures exchange in the world. They trade billions of dollars every day. They clear over 4 billion contracts a year. That wouldn't happen if it wasn't a fair, level playing field. So you and I can come in here and make a trade on that exchange and feel comfortable about it. Institutions that I deal with around the world who trade these markets, rarely do I go to a part of the world that firm is not trading these markets. They wouldn't do it if it wasn't fair. So you and I can have that comfort there as well. Now, I want to talk to you about one price technique, then we're going to get over to those markets. This is what I call behavioral Japanese candles. And this is not, I should tell you, for those of you familiar with candle charts, I imagine many of you are, I'd like you to take those ideas and put them aside while we're together. For those of you who are not familiar with candles, what I'm going to tell you is not the typical approach to this. This is the technique I saw in Tokyo, actually, at Bank of America. I was teaching a course on market profile, a different technique, to customers of the banks, like Sumitomo Bank, Daiichi Bank, different customers of the bank. They were yield curve traders. Part of the course was to go into the trading room, which was right next to the room I was in, to find some trades in 30-year treasuries. So I go in, we put some trades on, I'm walking out, I see a fellow drawing these candle charts. And I said, "Oh, Kuno-san, what are these?" And he said, "Oh, these are Japanese candle charts." Now, they were kind enough to talk to me about this, but what went through my mind is what I want to share with you. And it's what you would see and you would hear on a trading floor. And those principles apply to you and I looking at a trading screen, I believe. So for example, what you know is that the closing price is above the open. That box is called the body of the candle. I think it represents buyers coming into the market. And when the closing price is below the open, I think it represents sellers. Here, the high and low match the top and body of the candle, and you and I know it doesn't always do that. Sometimes the high price is above the body of the candle. That creates a vertical line called a shadow. I think it represents sellers at higher prices, and at lower prices it represents buyers. Here's some things to keep in mind. The range from the top to the bottom, from the high to the low, is a measure of volatility, a rough measure. The body, well, the body color, green represents buying, red represents selling. The size of the body is a measure of commitment. It's a measure of enthusiasm. It's a measure of momentum. If we look at the lines on top and bottom, the shadows, that is a measure of rejection. Here's what you want to keep in mind. When the market traded, let's look at the green candle. When it traded at the very high, that green candle extended to the top, to the high. But something happened there. It backed away from it, didn't close there. It closed down from there as it got high enough to find sellers. So those are the principles you and I are going to be looking at now with some market examples. One more thing I just want to tell you is I do a free daily video, and it's on 22 different markets, stock indices. It's the markets we're going to look at. And what you can do is this is dangramza.com. You just start here where you can see that, and then you'll see a video. That's the CME Group trading floor behind me. And then you click on Learn More under Free Studies and Get Started. And then you'll see a registration. You put in basic information. I do not do anything with your information. You can get a daily email if you want that tells you when the video is available. It's done every day. You can go back, I think it's over a year or 2 years, and see all the videos previously. So if you want to see what I was saying 6 months ago, you could do that. If you've never traded futures before, one of the places to begin is just watch them, look at them, see how they do unfold. And if you are trading maybe stock indices only, there may be some opportunities in other markets that you find interesting. And so this video gives you a view of those different markets. So that's really what we're looking at there. And let's go over now to those markets. And we looked at this before. We looked at the stock indices. There's a few things I want to, I should tell you about the red and green lines. The red and green lines, and this is for me, I'm not suggesting that anyone does this. These videos are watched in over 150 countries, and I don't know the understanding of the markets by the people who are watching this. So, but these are my references. I'm giving you an idea of how I would approach these markets. This happens to be the S&P. So this green line is a buy level. The red line is a sell level. And what you would see if you go back over time, this red line would be moving up as the time unfolds. And what we're seeing here, actually on Monday, it's so interesting. Oh, you know something? Let's do this. Let's take a look at Monday. And this is a 30-minute chart you and I are looking at. And let me get that up there for you. The reason I want to look at Monday, I want to show you an example of euphoria. There it is. Let's go back over to that. That big green candle you see there, that is an example of a euphoric move in the market. You know, it was the announcement that they're getting good results on this vaccine. And what's also interesting, you know, when this occurred, it occurred in your time zone. Here's how it works here. Right over here is 5 o'clock Chicago time, and that's when Asia begins to trade. So it's the next morning in Asia. All right, so here's Asia. It gave us a bit of a rally, and then it pulls back a little bit. Right here is where you start trading. You were quiet for a while, and then this announcement comes out, boom, the market moves up. Now, did it move higher because we have the vaccine and it's been distributed and people are getting it? No, it's just the idea that they're getting good results on this vaccine. So the market shoots up. That's a euphoric move. It's not reality. It's the anticipation. It's a combination of those things. And you can see what happened afterwards. It's almost like when the market got up here, it said, whoa, how did we get up here? And as it absorbed that information, then it started to back off a bit. It's good news, but it started to back off a bit. And see, these futures, it just allows you and I to see how that market's moving around the globe. And again, this is your time zone when that announcement came out. All right, well, let's go back to these, those are currencies. Let's go to
Yes,
back to
then
the
I think it
indices.
was at
Yeah.
about 1 o'clock our time when this big candle appears on the
Oh,
chart.
that excellent point,
Yeah,
Stefan. That because that was 6 o'clock in the morning my time.
yeah, yeah. Yeah,
Yeah, you're right.
but interesting that the market goes back in your time zone when you started
Well,
trading it.
yeah, because it goes back to a reality check. And
Mm,
see what would happen. Most people, when they'd wake up and say, whoa, look how the market moved, they immediately want to buy it, right? Because they think, oh
right.
my, this is fantastic. But if you look at that 30-minute chart, if we go back to this chart, what we saw here uh, is, or like, tell you what, I'll do 60, so it'll go a little quicker. If we go back and take a look at that, what we see, what happened afterwards? Did it maintain that momentum? Here's our opening of our market in the United States. So it was building up some momentum, but what did you and I see as the market moved higher? Here's a big, huge green candle. Buyers come in with both hands. A small shadow on top compared to that. The next period closes at its high. The next period, when it trades at that high, at that moment, it's green. But did we finish there? No. Did we break to the downside? Yes. When it traded at that low, that was a red candle. Then we pulled right back up. It shows us balance. It shows us uncertainty. And when the US market opened, it said, well, that's really good news, but gosh, it's not manufactured completely yet. It's not distributed. People aren't getting it. Is it changing our current virus situation, which is terrible around the world? No, it doesn't. So it's absorbing that news, but there was no real follow through. Could that have happened? Yes. But to me, it's a euphoric move. And what you see here is that reality check. And we're still in that mode, I think. So you're right. It is interesting to see how the US backed off from that. And if we look at that, if we continue to follow that, what's interesting also, let's go over here and let's take a look at right here. Here's where Asia started again. Boy, a different reaction, and it's also what we're seeing in Europe, fairly quiet. So it really, uh, I'm sorry, this is the US. Here's Asia. That's where it started. So it really gave us, some interesting clues about how the market's reacting to that information. And you know something, Stefan, what we should also take a look at, what did these other markets do? Let's go
Hmm.
back to this. I like what you
Yeah.
said.
What is the
Let's
impact in terms of the intermarket relationship? That's a good question. Yeah.
Yeah. So let's do this. We have a few more to look at here, but let's take a look at all these markets. And let me tell you what I have up here. In the upper left-hand corner, the very top, you have S&P, NASDAQ, Dow, Russell. So we have those stock index complex. And each one of these it has their own personality. They all represent something a little different. And if we take a look at what's happening next to that, we have the euro, we have the Swissy, and Japanese yen. The second row, we have Aussie dollar, British pound, Canadian dollar. And here's the dollar index. Then we have 10-year notes, 30-year bonds, and we have gold over to the right. The bottom row, silver, copper, crude oil, natural gas, soybeans, corn, and wheat. Well, if we go back and look at that day that we had the huge move up and then it backed off and the S&P, look right below it. What did the Aussie dollar do? Very similar, actually. And if you look over here, look up to the right side now, top row, look at the euro. The euro actually opened, moved up, and then it sold off. We really didn't see any follow through. It also, take a look. Let me move my, take a look. Whoop, let me go back here. There we go. Take a look at what Japanese yen did. It fell out of bed.
Mm.
So that means, and here, if someone doesn't trade currencies, let's just talk about this for a moment. When you and I look at these charts, when we look at the euro, for example, and I know you're familiar with this, but let's just, because some people may not. When you're looking at futures, those numbers you see on the right side here, those are dollars and cents. So what
Mhm.
we're seeing is the cost to buy €1 in dollars and cents. So we know when the market moves up to the right that the euro is getting more expensive. It means the dollar is getting weaker because we're getting less euro for our money. And right now, today, interesting, we're seeing the euro firm up a bit. But if we go back to what we saw here just a minute ago, we saw Japanese yen fall out of bed. We look down here right below it. Look what gold did.
Mhm.
It's almost like it said, you know something? The uncertainty is gone. Everything's okay now. Well, you and I know we're not at that spot yet, but it's a euphoric move. It's that assumption that we're seeing in a marketplace. And that's why I'm saying you typically don't get follow through after that. So if you and I look at it from the point of view, what is this fundamental telling us? Is it reality or is it hope? Is it anticipating the future? Remember, anticipatory moves are big moves, but they don't create a change in market direction. So I think
Mhm.
what we had there was reasonable. It's um, not unreasonable behavior. We saw it. Look in the lower left corner. Silver fell out of bed, did the same thing. We saw markets that are that value precious metal complex say, "Oh, wow, this is fantastic," until reality came in and we went sideways. So it's really interesting how the markets absorb news. One thing down here, I just want to point out quickly, if you move over to the right, you'll see soybeans, this guy right here. And soybeans actually had a big day up. And it goes back to what the expectation is. Oh, I should look at this complex with you. So let's do this. Let's go back and take a look at currencies, for example.
Mhm.
Right now we see the euro kind of went, this is what I call an equal and opposite. This, by the way, from the way I define this, that those two candles right there, let me move this over a little so I can see that. There we go. Um, is these two candles, this red followed by green, right? That is what I call an equal and opposite. In other words, it's the same if you add those two together, combine them as rejection. In other words, it looks like a big shadow on the bottom. Here's where we open on the first candle to the close of the second candle. There you'd have a small red candle and you'd have a big shadow on the bottom. So equal and opposite can be a very bullish setup. I do look for follow through for the euro to the upside. And here's the bullish level. Now, if we finish like this today, in this evening, after the
Mhm.
afternoon, actually, I'll probably lower that bullish level. Over in the Swissy, we're knocking on the door. It looks like it's getting ready to trade. Actually, it may have done that. Let me check that. Whoop. Let's see. Where is that? 109.66, and the bullish level there is at 109.90. So we're
Pretty
okay.
close.
Yeah, we're getting close. Anyways, sorry. So, and if that happens, what you would see then is I'd have a red line below that.
Mhm.
To me, stops are risk management, as you know, Steph, and it allows you and I to survive in these markets. There's no business decision that you and I can make that doesn't have risk, whether it's opening a business or doing something else. Once we put money exposed to risk, it's always important for us to manage that. And for me, it's critical. So once, if this would have traded through my bullish level, then I would now put a sell stop below that. And if it does cooperate, then that line would move with it.
Okay.
Japanese yen
I
is
think we,
also,
we, we have passed the
oh,
line there, the Japanese yen, right?
yes, the Japanese yen did. And I can tell you, let's see here. Let me get my glasses on. That bullish level was 95.50. And the bearish level there was 96.40. So that's 40, that's 90, that's 90 points. And if you take, now that's $12.50 per point. So if you take $12.50 times 90, that difference would be $1,125. And what's going to happen for me is, in fact, let's do that right now. Well, anyways, I'll do it later. But you're going to have a bearish line here, a red line below
Mm,
that green line.
mm, mm.
So this implies that they're following through. But you know something, Stefan, that I find interesting here? Let me show you something else too. It's this.
Please.
Yeah, it's how it moves above these shadows becomes very important. If
Hmm.
you and I operate on the assumption of what we talked about before, I said a shadow on the top represents selling, correct? So
Right.
that if you and I see this market trading above these shadows, it means that people who sold this are now losing money, right?
Hmm. Hmm.
So if we now start trading above them, these people are losing money. So what do those sellers do? They
They need
buy
to
it
close the
back.
position. Yeah.
Exactly. They close their positions. So that adds buying order flow. And we're seeing some of them helping this market move. If we stop here, it's not a super strong position, by the way. If we close near 70, then that would imply that those people have been cleared out,
Mm.
and I would look for follow through. With the day that we're seeing here right now, I'm not looking for a big day. If we finish like this on Monday, I'm looking for a relatively quiet day. And if you look at the other currencies, I mean, like the Aussie dollar, right now, Australia is having, oh, this is a good example of this too. Let me show you a little thought here that I use down here that helps me. And let me go back to that. There we go. Is this. I have something I call a benchmark candle. And
Okay.
if you look at this, what I mean by event benchmark candle, and this is, just a Dan thing. It's just a reference that I use. You have the same thing here in the euro. The benchmark candle is the most recent period with the greatest volatility. I look at
Hmm.
the midpoint and I look at the low. If we stay above the midpoint, it also implies buyers following through. If it takes a large number of periods to get down to the bottom of that benchmark candle, it implies profit taking, and I'm looking for a move up.
Ah,
In other
okay.
words, what buyers did in one period, it has taken 6 periods to come back. So have sellers come into this market with the same gusto that buyers had? And you and I would say no. So
Mm.
that's a clue The bias for this market is for a move to the upside. China has said, we're not going to buy your coal. We're not going, because you made some unkind comments, and we're not going to buy your iron ore. Well, I Australia sells the world's largest exporter of iron ore. Their thermal coal is perfect for coking. China is their biggest customer. For China's steel industry to continue, they need that thermal coal. They can buy some from Vietnam, but the supply they really need is Australia. And so maybe we're going to see some follow through. Here's one more thought with that. If you and I see this structure, that means within the next 2 to 3 days, by Wednesday of next week, let's do it
Mhm.
that way, we should be trading above 73.50. If we are not, I'm looking for a sideways move here.
Okay.
So it's really kind of an interesting setup. If we look at, maybe we should do this so much quickly. This is interest rates. You know, we've traded above its bullish level yesterday. That was the previous sell level, a bearish level.
Mhm.
That's $1,250 a contract. I'm only giving that just to give people a feel for what that means, dollars and cents. Doesn't mean anything other than that. Same thing over here in bonds. That happened to be $1,250 as well. Oh, people have asked so many times about Bitcoin. Let me just tell you about that, what happened there. Bitcoin, this is Monday. And
Mhm.
when Monday traded below its bearish level, or that magnitude change, and again, just it's only a reference, it doesn't mean anything. But to give you an idea of what that represented, that difference there was $6,500 a contract. Again, I'm
Okay.
not saying that's what somebody would make, but that's what the dollar value is of
Mhm.
something like that. If we take a look at quickly the metals, precious metals, here's that Monday. But again, are we pulling back? Are buyers coming back? But if we take 2 weeks to get back up to
Yeah.
1950 to 1960, then I look for a sideways to lower market. So the next couple of weeks are really important. Look at this one. Here's your benchmark candle. That's copper, and we're starting to go out the way
Mhm.
we came in. That's a positive move. China consumes 48% of the world's supply of copper. And if their economy continues to heat up, look for this market to go higher. At least that's kind of what I'm thinking. Crude oil, this market's backed off. It traded below its bearish level yesterday. And that magnitude change, again, just as a reference, is $5,000 a contract. This is the full size contract. But what and here we could trade a mini contract, which is
Mhm.
much smaller. So there's other tools that we could use. Crude oil, I think, is going to stay range bound. You know, $37 to $45. I don't see it getting above that even next year. We have tremendous supply. OPEC is going to cut back on their production. So we have a very interesting market. Nat gas, this is firming up. We are seeing some demand coming in actually from China regarding that market. And the last one is we can look at the grains.
The grains, yeah.
Yeah, the soybeans, I'm bullish on soybeans. I do look for follow through to the upside. You know, let's go back to our friends in China. You know, they're having a current food challenge right now. Their
Mhm.
demand for soybeans is incredibly high. They need these products. So long term, I'm bullish on these markets. But you can see here, and if you go back a couple of days in the video, you'll see the
Mhm.
day before it's that I call that rejection. And so this red line, which was moving up, was moved up to that level. Yesterday, we traded through that.
Mhm.
And the magnitude change in that market as a reference, just to give you a feel for that. Um, that was, find my sheet here, um, was I think that was 40 to 60. It's 20 cents. It's a little over $1,000 a contract.
Mhm.
But that doesn't, again, doesn't. Oh, let me tell you this. If I was a seller here at that red line, what's happened? It's not working. It
Right.
failed. We didn't get follow through to the downside. Here's your benchmark candle. Look how we're staying above the midpoint. The bias is for a move to the upside. So those are, gosh, but
Ben, it is so interesting to talk with you and to
well,
hear you. Thank you very much, but the hour is over,
I know, I'm sorry. I just looked at the
unfortunately.
clock. I
No,
apologize.
no. It's so interesting, and it was a great that what you said to us, and thank you very much that you have participated to our trading packet today, and that we could listen to you. It was amazing. Thank you so much.
Well, it was my pleasure. Thank you for having me. I want to thank the CME group also for making this possible. And
Yes, absolutely. Yeah, absolutely.
I'm
Later
very,
on, we will have Eric as well, Eric Norland.
oh
I'm
yeah,
looking forward
yeah,
to
yeah,
this. Yeah.
yeah. He's got some great ideas to share, I'm sure. But
Oh,
thank you
yes,
so
great.
much, Stefan. Thank you for your
Thank you.
making me feel so welcome.
Ah,
Cheers.
that's you're welcome. Thank you very much, and have a great day in Chicago.
You
I
too.
think it's morning now.
It is. Cheers.
Tschüss.